Is Jim Kramer really such a bad trader? Or is there something more sinister going on? Because just recently, a group of financial experts put together an experiment with some truly shocking results. They put $1,000 into what might be the dumbest investment strategy of the modern era. No research, no algorithms, no PhDs, no insider information, nothing. All they had to do was watch one man give stock and crypto advice on television and then take the exact opposite trade. That $1,000 then turned into $3,400. The money more than tripled. It beat ChatGPT's stock picks by 150 percentage points. It even beat Warren Buffett by almost 190. Now, the internet's conclusion is that Jim Kramer is simply the worst investor of all time. But guys, that answer falls apart the moment that you look at his track record before he got on television. You see, he went to Harvard. He then worked at Goldman Sachs, a hedge fund reportedly compounding 24% a year for over a decade. That's not a bad trader, that's something else entirely. And by the end of this video, you're going to see the machine behind it, because it's the same machine that marked the exact top of the Bitcoin cycle back in 2021. And it's running again right now at the bottom of the market. Do me a favor, hit the like button, and let's get into today's video. Now guys, let's kill the lazy take first, because the internet has turned Jim Kramer into a punchline. Inverse Cramer memes, parody accounts, the whole circus, right? But here's what the meme crowd has conveniently forgot. This man went to Harvard, then Harvard Law, he then worked at Goldman Sachs, and then he ran his own hedge fund for over a decade with compounding results of over 24% per year. And that was through the 1987 crash as well as the dot-com bubble. Pretty challenging times to be in the market. And it's pretty clear, you don't produce numbers like that by being an idiot, because idiots don't survive one bad year at a hedge fund, let alone a decade of good ones. So we have a genuine puzzle here. A man who is demonstrably brilliant with his own money, but suddenly becomes reliably wrong once he gets on television and starts telling retail investors what to do with theirs. And this has actually been covered by academics, because research covering his picks found that aggregate stock recommendations underperformed the S&P 500 from 2001 all the way to 2016. Think about that. Not a scam, not fraud, just reliably wrong enough to be a tradable contrarian signal. So, how does that happen? Well, there are two explanations. The charitable one is that TV changed the job. He's not managing money anymore, he's producing entertainment, and entertainment means being loud about whatever the crowd is already excited about, at the exact moment that they are most excited about it. The less charitable one, and I'll let you decide for yourself, is that he knows precisely what he's doing. The role of the financial television is not to inform you about trades you should be taking, it's to generate emotions on cue. Think about who comes on his shows. CEOs. And when does a CEO do media rounds? Well, when they've got something to sell to the public. Now, I can't read a man's mind, and I'm not accusing anyone of anything here. When he's pounding the table screaming buy, that's peak emotion and peak exposure. When he's telling you to panic sell, that's maximum fear. So betting against Jim Kramer was never really betting against Jim Kramer. It's a machine for selling euphoria and buying panic, which funnily enough is the oldest advice in investing. Be fearful when others are greedy, and greedy when others are fearful. And it got so well known that in March 2023, an asset manager launched an actual tradable fund built purely to short his picks. Now, here's the thing. The official fund closed after about 11 months with roughly $2.4 million in it. So sit with that for a second. The official professional managed Inverse Cramer fund lost money and then shut down, while the crude do-it-yourself version of just doing the opposite of whatever he called tripled. I want to be honest with you here, because the investor strategy itself has been erratic. Some years it beats the market, some years it gets crushed, but the erratic record is actually the whole point. You see, the functions entirely as a sentiment antenna. The signal isn't Kramer is always wrong. The signal is Kramer is the loudest exactly when the crowd is most emotional. Strip out the fees and the fund management timing decisions, take the emotional signal raw, and it works. So the question I'm simply asking, if a single TV host can accidentally become a mirror for retail emotions, what happens when institutions do this on purpose at scale? But guys, this is where it gets really interesting. Let me take you back to November of 2020. Bitcoin at the time was sitting around $16,000 to $17,500, and a report then conveniently leaked from Citibank, written by Tom Fitzpatrick, their global head of technical strategy. The title of that document: Bitcoin, the 21st century gold. The prediction in the document, $318,000 by December of 2021. Let me put that into perspective for you. That was a call for a nearly 20x move that was dropped into the market right as the biggest bull run in crypto history at the time was getting started. Pure euphoria fuel. And what actually happened? Well, Bitcoin then topped near $69,000 in November of 2021, almost exactly 1 year after that report was circulated. You see, it reached about 22% of the target that was given, and it topped out right around the time that everyone was still passing that $318,000 number around like gospel. Other banks began to add to the story, and at the end of 2021, we continued to hear about predictions of $150,000 and more. Now, I want to be fair here. Nobody has proven that Citibank timed anything deliberately, and the same analyst had a history of wild long-term calls. But here's the mechanism that nobody talked about, and it's the exact same one from the Kramer story. When a large institution wants to sell a massive position, they have a problem. Selling that much in one go crushes the price against them. So what do they need? Well, they need more buyers. A wave of eager, emotional retail buyers to come in and take position on the other side. And what manufactures a wave? Well, a euphoric headline, like a $318,000 price target, a promise that this time the sky is the limit. Picture a stadium full of people holding a small bucket, and a handful of people at the exits holding one giant tank. The euphoric headlines open the taps. Everyone rushes in to pour their money in, and then it quietly drains out through the exits. That, guys, is effectively how a liquidation extraction takes place. It's been happening in crypto as well as stocks for many, many years. Now, bullish news at the top is an invitation to become exit liquidity. So if that's how the top works, what does the bottom look like? Because it's the exact machine that we are seeing running in reverse right now. Look at what's been stacking up, because it's a textbook example. You see, Bitcoin has been trading down near $60,000 to $65,000, down nearly 45% since October of 2025, where it hit that high of $126,198. The fear and greed index has been camped in extreme fear for a very, very long time. And here's a genuine counterintuitive data point. Social volume just hit a 2-year low, around 41,800 daily comments. Nobody's talking about crypto. The retail euphoria is completely gone. Historically, that absence of excitement is a strongly bullish contrarian signal. But watch how the headlines pile it on anyway. First, the big one, probably the biggest one in fact, Michael Saylor's company, MicroStrategy, formally ended its never sell pledge. Remember, this guy was the one who was supposed to be pumping our bags, who was going to continue to buy forevermore, and we were all going to be rich because of him. Guess what? He decided to sell Bitcoin at the absolute bottom price. At least that's what the story says. Because in early July, they sold 3,588 coins for roughly $216 million, the largest single liquidation in the company's history. This is a man who's been saying that he's never going to sell, and he was saying that back in October of 2025. Now, honest nuance. Strategy's average cost basis is around $75,476 per coin. They're sitting on unrealized losses roughly around $10 billion, and the stock's market value dropped below the average of its own Bitcoin. This pivot is largely mechanical, selling to fund preferred stock obligations. But the headline that reaches retail is brutally simple. Even Saylor is selling. Nobody's safe. That's the fear signal. Then layer on top the geopolitics, the Iran-Israel ceasefire collapsing, and the US reimposing a naval blockade on Iranian ports on the 14th of July. Traffic through the Strait of Hormuz collapsed from around 140 daily transits to a handful of tankers. Brent oil then spikes again. And then the Federal Reserve's new chair, Kevin Warsh, who was sworn in back in May, pledging a regime change to defeat inflation. At his first meeting, the dot plot shocked the market. 9 out of 10 officials projecting at least one rate hike before December. And then when the market was been pricing in these hikes, Warsh explicitly said that the government would not be bailing out the crypto sector. So, higher rates for longer, no safety net, war, and now the biggest Bitcoin bull in Michael Saylor capitulating. So let me chain it all together for you. Fear headlines suppress sentiment. Suppressed sentiment scares retail into selling. Retail begins selling, creating cheap coins. And cheap coins are exactly what the slow money wants to accumulate quietly. Bearish news at the lows manufactures cheap entries, just like the bullish news at the highs manufactures exit liquidity. Now, here's the other side, and this is where you separate yourself from the crowd. So, while the headlines are screaming, Standard Chartered is holding $100,000 year-end target, framing strategy sale as purely a communication problem, and notice the new bullish bait already appearing, with unverified targets circulating online for $140,000 to $250,000 Bitcoin by December, well, does that sound familiar? It's the Fitzpatrick report all over again, except this time the bait is being planted very early on. In fact, last cycle, it was planted in 2020. Remember, the crypto market topped a year later in 2021. And when it comes to sentiment and news surrounding the crypto markets, history is often rhymed, and right now it seems to be rhyming perfectly, because the euphoric targets that appeared in 2020 and then later on in 2021 marked the region of the top. The fear stacking now is historically marking a region where the bottom is likely to take place. So how do you avoid being on the wrong side of the machine? First, when every headline is euphoric and a bank is calling for a 20x, your risk is at its absolute peak. That's when you take exits. Second, when the news is darkest, when even the loudest bull is selling, that's typically when you're nearer to the lows than to the highs. Third, focus towards real signals. Start looking towards on-chain data. Start looking towards the sentiment in the market. If everybody is fearful, if the news has been bad and everybody is expecting to see price go lower, it means that everybody has already got out the market. If everybody has already got out the market, what forces price down lower? Typically, price only goes lower when people sell, and it goes down lower fast when people sell fast. But since we've seen the market bounce back to the 60k level after bottoming back in early February, we haven't really seen any further capitulation because the market's already panicked. Everyone who wanted to sell already sold. No one's left to sell because those people are beginning to buy again. So whether or not we go down a little bit lower from here, the news, the media suggest that this is somewhere near the bottom. And in my opinion, offering very good value, because ultimately we do expect to see Bitcoin as well as the altcoin market being worth a lot more in the future. Now, I'm obviously not here to tell you what you should be doing with your money, so do your own research because you can't borrow someone else's conviction. So let's bring it all home. Back to where it started. Is Jim Kramer a bad trader? No, I don't believe he is. The man compounded 24% a year of his own money. But on your screen, he's something else, okay? He's a mirror. And that $1,000 bet against the mirror tripled, because it was never a bet against him. It was a bet against the peak emotion. A leaked $318,000 call marked the region at the top of the last cycle for crypto. And right now, with Bitcoin down 49%, Michael Saylor has been selling his largest ever chunk, and a hawkish new Fed chair is also serving up more fear thick and fast. Once you understand that hype clusters at the top and blind panic clusters near the bottom, you stop reading the headlines and news information and paying attention to influencers or whoever it might be, and you start reading them as signals of where the crowd is emotionally. Because remember what I said about the stadium. In the stadium, you had all the people in the stadium handing the money to a handful of people at the exit. This is the same in crypto. You never see the handful of people at the exit handing the money to the stadium, which is why contrarian signals, or doing the opposite of the main idea across the market, is ultimately always going to make you much more successful in crypto. So anyway, let me know down below whether or not you think that we've already bottomed for Bitcoin and the altcoin market. Let me know down below what other news story you can think of that could be able to push the Bitcoin price down to $50,000 or $40,000 like the general consensus is across retail investors. And let me know what you want me to cover in the next few videos. If you haven't already, make sure you're subscribed to Peter Anthony Finance, where we'll be covering not only crypto, but also moving into the macro world, because obviously there's lots of links between them. If you've just discovered this channel, then make sure you also subscribe to the House of Crypto, where we cover lots of crypto content, talking about psychology, on-chain data, different altcoins and things that I'm personally investing in, and much more. Guys, do me a favor if you haven't already, hit the like button, leave a comment down below, and subscribe, and I'll see you very soon in another video. Bye-bye.